Welcome to this edition of Investment Insights. Today we have Hayden Tyrrell with us. Welcome, Hayden.
Thanks, Laura.
The Russia-Ukraine crisis has been ongoing for a while now, with sanctions being put on Russia from countries across the world. How has this impacted markets both worldwide and in New Zealand?
Two key themes are driving markets at the moment. These are inflation and the conflict between Ukraine and Russia. The conflict came at a time when global share markets were already showing increased levels of volatility. This was off the back of signals from central banks around the world that they would start to wrap up their supportive monetary policy regimes in response to soaring inflation. This shook global share markets, as a key asset in the tool belt of a central bank is to raise interest rates. We've seen this happen in New Zealand recently, with the Reserve Bank of New Zealand raising interest rates and these increases feeding through to the likes of mortgage rates. This hits businesses the same way that it hits households, resulting in increased loan expenses, lower profits, and a lower share price. The conflict only added to the volatility as investors questioned the severity and also the ripple effect it would have on many industries and regions. As a result, we saw global share markets continue to sell off and investors moved their money to traditional safe haven assets, such as treasury bonds and gold. We also saw commodity assets such as oil and wheat have large price fluctuations, as the conflict's impact on supply of these assets was questioned.
War and conflict creates instability, which we have seen with the migrant crisis and financial markets. With the duration of the conflict unknown, do we think there will be continual market instability going forward?
Whilst the war continues and questions remain around how it can impact markets, we will see increased levels of market volatility. In saying that, we saw a broad-based recovery in equity markets across March, and the VIX index, which is a measure of volatility in the S&P 500, has retreated, indicating less expected volatility in the markets. The shock of the conflict has at this time been priced into markets. However, it will not take much to change this if a further escalation occurs or the war spills over into a neighbouring NATO country.
Flash flooding recently seen across the Pacific is becoming more frequent with climate change. Cities are learning to adapt. How are the portfolios adapting to climate change?
Sustainability is one of Mercer's core investment beliefs. Last year, Mercer New Zealand committed ourselves to achieving net zero carbon emissions from all of our investments by 2050, with a 45% reduction by 2030. This means that we're actively working towards a lower carbon future through collaborating closely with our investment managers to reduce portfolio carbon emissions and avoid companies that will be adversely affected by climate change. Instead, investing in solutions that aid the transition, like renewable energy and digital technology.
Inflation numbers in New Zealand and around the world are at historical highs. This tends to provide headwinds for financial assets. How are the portfolios set up to deal with inflation?
That's right, Laura. Inflation in New Zealand was 5.9% over the past year, and we've seen similar levels globally. We expect it to remain elevated over the short term and then trend back down to more normal levels in the medium to long term. The portfolios are stress tested regularly for a range of different scenarios, including higher inflation, to help us understand how they would behave in that environment. Their diversified approach means they have allocations to inflation-sensitive assets, such as listed property and listed infrastructure, that should help smooth returns in a higher inflationary environment.